I mean, tariffs are actually, we've had a lot of experience with them. They're an act of war to some degree.
How do you think tariffs will impact inflation?
Over time, they're a tax on goods. I mean, the tooth fairy doesn't pay.
Have you ever wondered why some products suddenly get more expensive even when nothing seems to change? That's often because of something called a tariff. Right now, the global economy is tangled in a web of tariffs, trade wars, and shifting alliances. Countries are taxing each other's goods, industries are getting hit, and consumers are paying the price. In this video, we're going to break down what tariffs actually are, how they affect your wallet, and why they matter more than ever. And now, Warren Buffett is finally speaking up. In a rare interview, he's sharing exactly what he thinks about what's going on, and he doesn't hold back. He calls tariffs an act of war. So let's start there. And if you're new here, make sure to subscribe for more investing breakdowns, real-world finance insights, and clear explanations of what's really going on in the economy. Let's run the interview.
I mean, tariffs are actually, we've had a lot of experience with them. They're an act of war to some degree.
How do you think tariffs will impact inflation?
Over time, they're a tax on goods. I mean, the tooth fairy doesn't pay.
Warren Buffett didn't hold back. But you might be thinking, what exactly is a tariff, and why does it matter? A tariff is a tax that a government places on imported goods. So when one country ships products into another country, the government receiving those goods can charge a fee at the border. That fee gets added to the final cost of the product, and usually it's the consumer who ends up paying for it. The idea behind tariffs is to protect local businesses. If foreign products become more expensive because of tariffs, people are more likely to buy from domestic companies. That can help certain industries grow at home. But tariffs can also backfire. They can trigger trade wars, where other countries strike back with their own tariffs. That hurts exporters, raises prices, and can slow down the whole economy. We've seen this before. Throughout history, tariffs have been used as tools of protection, but they've also been blamed for making economic problems worse, like during the Great Depression. A prime example of tariffs backfiring is the Smoot-Hawley Tariff Act of 1930. Intended to protect American farmers and manufacturers during the early stages of the Great Depression, this act raised U.S. tariffs on over 20,000 imported goods. However, it led to international retaliation, with countries like Canada imposing their own tariffs on American products. This escalation contributed to a significant decline in global trade, exacerbating the economic downturn. Recently, the U.S. imposed sweeping tariffs, including a minimum 10% tax on nearly all imports. This move has already shaken the markets, with the S&P 500 dropping close to 10%. Countries like China have responded with their own tariffs, and major industries like automotive and electronics are starting to feel the pressure. We're seeing early signs of layoffs, factory slowdowns, and rising prices across the board. To put it simply, tariffs are meant to protect, but they come with a cost. And when powerful economies start using them like weapons, it doesn't just raise prices, it raises tensions. Let's break down exactly how this works. Let's say a company in the US wants to sell smartphones that are made in another country, like China. Normally, the company buys the phone for $800 and sells it here for about the same price, maybe a little more to make a profit. Now imagine the US government adds a 10% tariff on imported smartphones. That means the company now has to pay an extra 10% tax just to bring the phone into the country. So instead of paying $800, they're now paying $880. That extra $80 is the tariff. But the company doesn't want to lose money, so they pass that $80 onto the store that sells the phone. And then the store passes that cost onto you. So the price tag for that phone is now $880 instead of $800. Not because the phone changed, but because of the tariff. And this doesn't just happen with phones. It happens with cars, clothes, TVs, food, basically anything that gets imported. That's why tariffs can make everyday things more expensive, even if you don't realize it's happening. So when Warren Buffett says, the tooth fairy doesn't pay them, he means someone has to cover that cost. And most of the time, that someone is you. So what's the real goal of tariffs? Because on the surface, it seems like they just make things more expensive, And that doesn't sound ideal, right? Well, the main idea behind tariffs is to protect local businesses from foreign competition. When imported products are cheaper, companies in the US can struggle to compete. So the government adds a tax to those imported products to make them more expensive. That way, US-made products look more affordable by comparison. Here's how that works in real life. Let's say you're shopping for a new car. You're deciding between two options, one made in the US and one made in Germany. The German car costs $30,000 before shipping or taxes. Now, the US government adds a 25% tariff on imported cars. That's an extra $7,500 just to bring the car into the country. So now, instead of costing $30,000, the German car costs $37,500, and that's before the dealership adds their markup. After all that, you could be looking at a final price of $40,000 or more. Meanwhile, a similar US-made car still costs $30,000, no import tax. So for most buyers, the American car is the better deal. That's exactly what the tariff is trying to do, make the foreign option more expensive, so you'll choose the one made here. It's meant to protect US jobs, factories, and industries. So while tariffs are meant to protect local industries, they can also raise prices and spark trade wars. But there's another issue Warren Buffett has been warning about for years: trade deficits. In simple terms, a trade deficit happens when a country buys more from other countries than it sells. The US has been running trade deficits for decades, and Buffett sees that as a long-term risk. Back in the early 2000s, Buffett said running big trade deficits is a significant minus for the country. He warned that if the US keeps importing more than it exports, foreign countries will end up owning more and more of our assets. Things like real estate, factories, and even companies. And when that happens, the profits from those assets don't stay in America. They flow overseas. Take a listen.
When you run a trade deficit, what you are doing is you're trading assets of one sort or of another for goods beyond what you're sending abroad. So in effect, you are selling off a tiny bit of the farm so that the country can consume more than it's producing. If you run a net trade deficit, the country in aggregate is consuming consuming more than it's producing. And if you're a very rich country, you can't even see it, because if you run a trade deficit of a few $100 billion, compared to an economy that may be worth, $40 trillion or something like that, you don't see it. But you're trading off a tiny bit of the farm every year to live a little bit better than if you just lived off the produce of the farm that year. And you can do it with IOUs if you've got a good record. You can't do it with IOUs if you're a country that's got a terrible record. So they have to denominate their debt in dollars, and of course, they don't have the ability to denominate a lot in dollars, and people don't want to accept a weak currency. So a weak country can't get away with doing that unless it's getting special type loans from agencies set up to do that. We can do almost anything we want in this country because we don't confiscate property, and we haven't destroyed a currency that people have accepted in terms of payment for their goods over the years. But I basically think a significant trade deficit over a long enough time is a significant minus for the country. You won't see it though day by day or week by week or month by month. But eventually, if you trade for trinkets or whatever you're getting beyond what you're sending, and you trade away your assets. Fortunately, some of the assets we traded not that many years ago, like movie studios and some of those things, the other people got the short end of the bargain on. But by and large, it's not a good policy for the country to run large trade deficits year after year.
He even wrote an article in Fortune where he laid out a plan to fix it. He suggested a system where importers would have to buy certificates from exporters, forcing trade to balance out. In other words, if you want to bring goods into the US, you'd have to match it with something the US sells to the world. Now fast forward 2 decades later, and Warren is still saying the same thing.
I think it was in 2003, Joe, I wrote an article for Fortune actually about the trade deficit. I was worried about it getting too large then because, again, it was getting to be 3% or so of GDP. It wasn't specific to China at all, but it was just a question of how wise it is to let the trade deficit grow larger and larger, because when you run when you are in effect buying more from other countries than they're buying from you, you are handing them investment funds. I mean, it's the nature. You give them little pieces of paper and they can convert that into buying. They can buy government bonds, they can buy buildings here. And Japanese bought Pebble Beach in the 1980s when they were running a big surplus. I mean, so you are giving up claim checks on our country, essentially, in exchange for having more consumption now than you're producing in this country. And so I do think that there's levels of trade deficit that bother me. I had some system that did not make it country specific. But I think the world has gotten better and better, and there's no question that countries may try and take advantage in this or that, and we've actually been guilty of that sometimes in the past too. I don't think leaders in other countries, whether China or 100 other countries, are not smart enough to realize that it's in the interest to keep promoting trade. The more we trade over time, and we don't want it to be a question of where we import 20% of our GDP and we export nothing. Now, we could all quit working, and we could hand little pieces of paper to the rest of the world, and they could keep sending us food, and they could send us autos, and they can send us all kinds of things. But eventually they have claims on all our wealth. So we do want to have policies where the overall trade deficit does not get out of hand in relation to GDP. And I've been arguing that for a long time.
Now, the big issue of trade is the growing imbalance between what the U.S. buys and what it sells. The country is running a massive trade deficit, and it's been that way for years. When we import way more than we export, it puts U.S. industries at a disadvantage. Local manufacturers can't compete with cheaper goods coming from overseas. Over time, that forces them to cut costs or move operations abroad. That's when we start losing jobs. One example is the U.S. electronics industry. Over the years, many American electronics companies have shifted their manufacturing to countries like China, Vietnam, and Mexico to cut costs. Products like televisions, smartphones, and computer parts that were once made in the U.S. are now mostly assembled overseas. That shift has led to the closure of factories in places like California, Texas, and the Midwest. Thousands of skilled manufacturing jobs disappeared, and entire communities that relied on those plants were left behind. It's part of a long trend. Back in 1979, nearly 20 million Americans worked in manufacturing. Today, in 2025, that number has dropped to about 12.76 million, a 35% decline. And manufacturing now makes up just 8% of all U.S. jobs, down from around 28% in the late 1970s. Warren Buffett sees this as a major risk. He's warned that if we keep running large trade deficits, other countries won't just be selling us goods, they'll be buying up our assets. Factories, land, businesses. Over time, the profits from those assets leave the U.S. and we're left more dependent, with less control over our own economy. To really understand how trade deficits and outsourcing impact everyday life, let's look at a real example, one that shows how an entire city can be changed by global trade. Youngstown, Ohio was once a booming steel town. For decades, it was one of the centers of American industry. Thousands of workers filled the mills, producing steel that helped build cities, bridges, and highways across the country. But in the late 1970s and early 1980s, everything changed. As the U.S. began importing cheaper steel from other countries, American steel companies couldn't compete. One by one, the mills in Youngstown shut down. In 1977 alone, more than 5,000 people lost their jobs when a major plant closed, with almost no warning. The impact was massive. Businesses collapsed, people moved away, the city's population dropped, and its economy never fully recovered. The trade imbalance didn't just hurt companies, it dismantled an entire community. Youngstown became a symbol of what economists now call the Rust Belt, a region hit hard by global trade, outsourcing, and a shrinking industrial base. And while the headlines have faded, the consequences are still being felt today. This is the human side of trade deficits. It's not just about numbers. It's about what happens to real people when entire industries leave. Now, let's look at another big issue Warren Buffett warns about: foreign ownership of U.S. assets. Buffett once said that running a trade deficit is like handing out claim checks to other countries. When the U.S. imports more than it exports, those other countries end up holding U.S. dollars. But they can't use those dollars at home, so they bring the money back into our economy. Take China, for example. Let's say the U.S. imports $1 billion worth of electronics from China. That creates a $1 billion trade deficit. Now, China is sitting on $1 billion in U.S. dollars. They can't use that money inside China, so instead they use it to buy things here. That might be stocks, it might be U.S. government bonds, it could be real estate, land, or ownership in American companies. And once they own those assets, they start collecting profits, interest, dividends, and rent from the U.S. economy. So now every year, American businesses and the U.S. government are sending money back to China, not just for goods, but for the income those assets generate. Over time, China ends up owning more and more and more, and we keep paying more. This is what Buffett is concerned about. It's not just about buying stuff from overseas, it's about slowly transferring ownership of American production, land, and capital into foreign hands. And that means we lose control over our own future. That's where tariffs come in. Some politicians argue that by adding tariffs to imported goods, like electronics, cars, or steel, we can make US-made products more competitive. The goal is to reduce imports, increase domestic production, and cut the trade deficit. But like we've already seen, tariffs can raise prices for consumers. They also make it harder for businesses to plan, which can slow down investment and growth. Trade deficits aren't just about money, they're about control. They can lead to job losses, factory closures, and more foreign ownership of key US assets. Tariffs are one way to fight back, but they come with costs. Warren Buffett isn't saying trade is bad, he's saying we need to be smart about it. Because if we don't fix the imbalance, we could end up working in an economy that we no longer fully own. If you found this helpful, subscribe for more videos that break down the economy in simple terms, so you actually understand what's going on.